Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Today's topic is U.S. market analysis, geopolitical whiplash, and sector divergence. This video presents a direct informational narration of the source document. So what a day on Wall Street, right? It was a real roller coaster, all thanks to some whiplash-inducing headlines that sent stocks swinging. We're going to dive into that and also look at a really interesting split that's happening right now in the tech world. All right, first up, this geopolitical whiplash. The U.S. market really got thrown for a loop today. We saw these dramatic reversals, all driven by a super fast-paced and kind of confusing series of headlines about what's going on with Iran and Israel. Let's really break down how this all played out.
The morning started off surprisingly calm. Before about 1 o'clock, the market was actually holding up pretty well, just shrugging off all the chatter about renewed conflict. And then, bam! The floor just fell out. Around 1 p.m., a single headline about Iran changing its negotiating team sent stocks into a complete nosedive. Then came the panic, fueled by these unconfirmed reports of airstrikes in Tehran. For a minute there, it really felt like we were on the brink of a full-blown crisis. But just as fast as it all started, the sell-off reversed. Official denials from both Israeli and U.S. officials came out, and it was like throwing water on a fire. The market just clawed back almost everything it had lost. A total sell the rumor, buy the news moment. And it all happened in just a few hours. Absolutely wild.
Okay, so now that we've seen the minute-by-minute action, let's zoom out a little bit. Let's take a look at the bigger picture and see how all that crazy intraday volatility showed up in the key indices, and of course, the market's fear gauge, the VIX. So how did all this drama register on the market's vital signs? Well, the VIX, Wall Street's fear gauge, it spiked up to 21.6. But then it fell right back below 20 pretty quickly, which tells you the panic really didn't last long. And if you look at the S&P 500 chart, it closed with what's called a doji star. It kind of looks like a plus sign. That's a classic signal that even with all the crazy swings, buyers jumped in and held the line, preventing a major breakdown. What's really interesting is that nobody seemed to care that oil prices were rising. The market just saw it as a temporary thing. It seems the real story, the one everyone is focused on, is still corporate earnings and the AI boom. As long as oil doesn't get totally out of control and make the Fed hike rates, that's where the attention is going to stay. And speaking of that boom, while the rest of the market was getting tossed around, one sector has been on an absolutely historic run. I'm talking about the Philadelphia Semiconductor Index, which has now rallied for 17 straight days. 17! The source we're looking at put it perfectly, I think. They said, this is no longer a bull market, this is bull demon king possession. That gives you a sense of just how insane this rally has been. Now today we did see a little bit of profit taking. The daily chart shows a long upper shadow, which basically means the index hit a new high but couldn't hold it. But don't let that fool you. The feeling in this sector is still red hot. And with Intel's incredible earnings report after the close, you can bet that's only going to pour more fuel on the fire. And that incredible strength in chips, well, it brings us to what might be the biggest theme of the day. And that's this really clear and growing split between two different parts of the tech world, AI hardware and enterprise software. It really is a tale of two techs right now. In one corner, you have the AI hardware folks, the ones building the picks and shovels for this AI gold rush. Money is just flooding into any company that touches AI infrastructure, GPUs, CPUs, you name it. But in the other corner, you've got the enterprise software companies. And for them, it feels like the party's over, at least for now. Their little rally came to a screeching halt, and investors are back to asking some really tough questions, like, hey, where's that AI growth you guys promised? So this is the million-dollar question, isn't it? Was that recent little bounce in software stocks the real deal, the start of a new uptrend, or was it just a temporary breather in what's actually a longer-term downtrend? The tricky part is, most of the big software companies don't report earnings until late May or early June. So for the next few weeks, the market might be flying a bit blind. The real answer is probably going to come from those reports. Okay, let's switch gears and do a little rapid-fire rundown of the day's biggest earnings reports and the individual stocks that were really making waves and shaping the whole story. Man, after the market closed, Intel just dropped an absolute bombshell of an earnings report. They didn't just beat what everyone was expecting, they completely blew it away. Revenue came in at $13.58 billion. That's over $1 billion more than predicted. Their data center and AI business brought in over $500 million more than expected. And get this, adjusted earnings per share were 29 cents. The street was looking for a single penny. And to top it all off, they guided higher for next quarter, basically saying, hey, we're just getting started. So why the huge numbers? Well, the company said it really comes down to how essential CPUs are in this new AI era. The CFO also pointed out that they're successfully raising chip prices to cover rising costs, and you could already see some of that effect in these Q1 results. This great news had a ripple effect, too, lifting shares of other CPU-related names like ARM and AMD in after-hours trading. At the exact same time, the software space was a total bloodbath. It was a classic case of good just isn't good enough. Take ServiceNow. They had a solid quarter, but investors were looking for definitive proof that they're a huge beneficiary of AI. They didn't get it. And the result? The stock got crushed, down almost 18%. Same kind of story for IBM. They beat earnings, but they didn't raise their guidance for the year, and that was enough to send the stock down over 8%. Even a massive $25 billion buyback couldn't save Adobe. The market's message was loud and clear. Show me the AI growth, or I'm selling. Tesla was on a wild ride today after its earnings. On one hand, the Q1 results were better than expected, and gross margins looked better too. But the big hang-up was this huge increase in future spending. They guided their 2026 capital expenditures to $25 billion. That money is all going to AI, robotaxi, and the Optimus robot. It's a huge signal that they're pivoting from just a car company to a full-on AI company. So now the market is trying to figure out what to do, weigh this incredibly ambitious long-term vision against some serious short-term pressure on their cash flow.
Elsewhere in the market, we saw something really dramatic. A recent meme stock darling just came crashing down, as it looks like the big short squeeze in Avis Budget Group is, well, it's violently unwinding.
Yeah, the Avis short squeeze has officially imploded. After falling 38% yesterday, the stock just cratered another 48% today. The trading was so nuts, they had to halt it multiple times. It really looks like the big players who were pumping this thing up are now cashing out and leaving a lot of damage behind. But here's the interesting part. The short interest is still really high. That means there are still tons of people betting against the stock. So we could actually see another round of fireworks here before this whole saga is over. And just to round out our tour of the market, let's look at some other big movers. On the downside, Lululemon fell over 13%. Investors really did not like their choice for a new CEO. Supermicro also took a hit on a report that they lost a big order from Oracle. And even American Express fell despite a solid quarter. But on the bright side, United Rentals was a huge winner, soaring 23% after a monster earnings report. It just goes to show you, even on a day as crazy as this one, fundamentals still matter. Okay, let's shift our focus overseas for a second and take a quick look at what's been going on with Chinese stocks and how they're stacking up against the rest of the world. So, over in China, there were a few new headlines in this ongoing tech rivalry. The US accused China of stealing AI tech, which put a little pressure on Chinese stocks. But honestly, the real story here isn't the geopolitics, it's just the performance. The Hang Seng Tech Index, which tracks all of China's biggest tech names, is just getting left in the dust by markets in Korea and Taiwan. While everyone else is booming, China's tech sector just seems to be stuck. And until that changes, it's going to be a pretty tough environment for investors over there. And all of that brings us to our final thought for the day. Today's action drew a really sharp line in the sand. On one side, you have the companies building the AI infrastructure. On the other, you have the companies that are supposed to use it. As the market keeps making this distinction, the big question for every single investor has to be, in this new AI world, where does the true long-term value really lie?